Early stage investing is an extremely important part of our portfolio construction. On one end, it's highly profitable to invest in them. On the other end, it also gives us valuable insights and access to emerging technologies. So I think it's a very important part of the portfolio. The idea there is to identify early winners and grow with them as they get to more regional, more global champions, right?
This is Chills with TFC. I'm your host, Reggie, aka Your Chief Financial Coconut, and today I have my co-host here. And every time the co-host comes in, you know there's something special. Right?
Yeah,
that's a fair point, right?
Every time this co-host comes in, there's something special.
Every time this co-host comes in, there's something special. So yes, Anthony, for everybody that somehow don't know you, you can introduce yourself.
Yes, hi, I'm Anthony. I'm part of the TFC crew and we do all the investment related content. So if I'm here, it means that there's investment related content coming up.
Yeah, this co-host.
This co-host.
Not
Only
all
this one.
co-hosts are great, right? And yes, today is a special episode. I personally was very excited when we got in touch with the Temasek team, right? So we are going to talk about how Temasek invests, right? So very happy to be Alpin. You want to introduce yourself?
First of all, thanks Reggie and Anthony for inviting me today. I'm very excited to be on this show. Maybe let me start with a quick introduction of myself. My name is Alpin. I've been with Temasek for 20 years now.
20 years.
20
So
years.
you got how many long-term service award?
A lot. I just got the last one, which is 20 years, and waiting for the next one to come. But yeah, no, I think it's been an exciting journey for the last 20 years. In fact, I was very lucky to have joined them in 2004. And that's actually a very important year in the journey of Temasek. When I joined them, we had one office, which was in Singapore. We were largely a Singapore holding company. Fast forward 20 years today, we actually have 13 offices across 9 countries. We have employees from 34 nationalities. And we've actually transformed ourselves from a Singapore holding company to be a truly global investor today. And a little bit about myself in Temasek. I have 2 roles. I head the real estate team, as well as I'm the deputy head for private equity fund investments. And within real estate, we actually invest across the capital structure. So we do both debt and equity and things in between. And we invest across US, Europe, and Asia, and also monitor our portfolio companies that you may know, such as Mapletree, Capital Land. And on the private equity fund investment side, we invest into a portfolio of top tier private equity firms. And we also do co-investments and co-underwrites along with them. And some of the examples are funds like KKR, TPG, and likes of those.
We keep hearing those 2 names.
Yeah, of course. And that was the question I wanted to ask. So what is considered top tier in your view?
Yeah, he'll get censored for that.
So everyone else is not top tier,
Everyone
right?
is top tier.
Everyone is working towards top tier. But in your view, what is top tier?
Yeah, I think the idea there is to really find the top performing firms and try the managers and GPs that we can actually invest alongside with. So I think we have a systematic process on how we evaluate each of those funds before we invest into them.
Fair.
Good for him to come on because today we are just really talking about capital allocation.
Of course.
And how that relates to individual investors. So to have somebody who wears both hats, who covers debt and equity and a variety of markets and a variety of asset class.
Yeah. We got a lot of questions. Yeah. We got a lot of questions.
Yeah, so I think you were speaking a bit about the expansion, right, of Temasek over the past 20 years. Also the evolution from being investing Singapore capital in Singapore-based companies to something that's a bit more global. Why don't you give us a brief whistle-stop tour of your view of the world, or Temasek's view of the world currently, and where we see the landscape, evolving and going forward as well.
Important question.
If you look at the global economy today, it actually has been much more robust than expected. The growth has been fairly good in the recent years. I would say the recession risks have pretty much kind of subsided now.
So we have hit a soft landing, or is it kind of no landing at this stage?
I would say, there are 2 things that we got to think about in that scenario, right? One is inflation and interest rates. And the second one is all the geopolitical conflicts that are existing today. So if you look at inflation, it's actually starting to come off. Of course, it's coming off from a very high level, but this would actually allow a lot of central banks around the world to think about easing monetary policies. And we've started seeing some of them actually take some action on that. If you look at geopolitics, that remains a key concern. I mean, you look at the conflicts between US and China, you look at the conflicts in Ukraine, in Gaza. I mean, to add on to the layer of complexity, we have elections coming fairly in large amount of countries around the world, and especially US. I think those risks will remain. But moving forward from there and talking about where do we see opportunities, what is our investment stance today? I would say we actually remain fairly constructive on US. We are looking at increasing our exposure in US, and we will invest in things like AI, the AI enablers, the AI adopters. We'll also invest into businesses that benefit from domestic policies. Moving on to Europe, we actually see opportunities in green transition and infrastructure in Europe. We also see opportunities to invest in global leading companies, European global companies. Moving into Asia, if you look at India, we are looking at increasing our exposure in India because India just continues to benefit from the structural tailwinds and reforms. And there is a good amount of political stability in India with the government getting the third term now. We've been fairly active there. I would say coming to China, I think we are cautious. And this year, we will continue to watch the government policies more closely. And we actually have been increasing our exposure and investing in Japan. And in the near term, we actually see interesting opportunities in private credit and also in private equity, which is one of the teams that I manage in Temasek, because a lot of GPs are looking at capital solutions there.
That's why he has to say private equity got a lot of opportunity.
It's his team. We have vested interest here.
Okay, so maybe just to set the context a bit, right? Because I understand about increasing exposure, but in terms of Temasek's current allocation, in either geographically or in terms of asset class, what does it look like now?
We actually actively reshape our portfolio depending on the changing landscape in macroeconomic factors or regulatory or geopolitical factors, right? The aim for us to do that is to be able to create a resilient portfolio, a forward-looking portfolio that can then deliver sustainable returns over the long term. So we have three components that I would talk about. The first one is investing in structural trends. So if you would have seen, I think we have spoken about this for a while now, we have identified 4 structural trends that we invest into. The structural trends are digitization, sustainable living. We invest into longer lifespans and future of consumption as well. So if you look at the first two, which is digitization and sustainable living, they are very pervasive trends and they kind of cut across many different sectors, different business models. And then if you look at the future of consumption and longer lifespans, they kind of address the changing needs of the consumer and also the needs of an aging population across many countries in the world today. And if you look at our investments in these 4 trends, that has actually gone up from, say, 13% in 2016 to 39% today. Incrementally, almost over 60% of our investment goes into these 4 trends. The second way we think about reshaping is from markets perspective. So if you look at our investments in developed economies like US and Europe, we've actually doubled our investments in the last decade. US has been the largest destination of our capital outside of Singapore. If you think about India, we've actually been actively investing in sectors like life sciences, consumer, technology, financial services, green transition, and many others. And India is now 7% of our portfolio. So I think we kind of reshape our portfolio on markets as we see opportunities in those markets. And the last, which is a big part of our portfolio, are our portfolio companies. We call it Temasek portfolio companies or TPCs, as you would have heard. And that's about 40% of our portfolio. So the idea is to engage the board and the management teams to focus on long-term value creation in these companies. So we'll engage them, we'll share our views, and then we will let the management teams and board make that decision and drive their business transformation.
So you have a bit of an observer seat at the board level, a bit of control rights, things
so
like
what
that.
we do is that we kind of engage them, we share our views, but we do not direct these companies. Whether it's at the board level or whether it's at an engagement level, we share our views and we leave it to the board and management team to drive and make their own decisions. And we hold them accountable for the performance of the company. But if they need a shareholder vote, then we will make the decision based on our commercial principles, whether we support and partner them on their transformation journey. Those are the three components. Maybe that gives you a flavor of how we build our portfolio and reshape our portfolio.
Yeah, fair. I have a lot of questions, and I think you've laid down some trends, right? And I think the trends are quite self-explanatory, right? I don't think people need to question that trend. It is quite the consensus. But I think how that investment then plays out in the different geography that you pick, it's quite interesting, right? So I want to understand why, based on these trends that you're going for and the investment ideology that you have set up, why are you increasing more in the developed market? Right. So why are you investing your capital allocation in like the US, in the Europe? Yeah. So just
I think that's a very good question. And it's a natural question. So if you think about US, I think first of all, US is the deepest and the most efficient financial market. So if you think about it from an opportunity set, there are a lot of opportunities that you can find in the US. And even if you look at US as an economy, I think you would see a lot of innovation, a lot of business growth that's been happening in the US. And if you think about it then from the perspective of the trends that we have put out, we see a lot of opportunities across different industries in the US. We've been very active in parts of financial services in US. We've done a lot of investing in life sciences and healthcare in US. We have invested in innovation, technology in US. AI is one of the areas. We also see interesting opportunities in private equity and private credit that kind of cuts across all these industries. So I think it's also a factor of the attractiveness of the opportunity in the US, and that drives our decision making because we are sort of a bottoms up investor to some sense. We kind of build up our portfolio based on the opportunity we see across different things. And we don't have any allocation as such. So I think that kind of drives the construction.
Fair. So you don't have an allocation geography mandate in some ways, right? Okay. So the baseline thought is that because the capital market is the deepest and the widest in the US, so it's easier for you to kind of find opportunities that fits your thesis. That's the idea.
Yeah, and you've seen good amount of growth in the US
of course,
in the last decade or so.
Yeah.
Like if you think about it, when we started our transformation journey in 2004, the first decade of our transformation journey out of 2 decades, we were actually heavily invested in China and India. We, in the first decade, which is 2004 to 2014, actually benefited significantly out of the growth in China. But if you take the next decade, which is the 2015 to 2024 decade for us, I think US has been an outperformer in that basis. So that drives a lot of the decision making.
So, but does that extend then to 2024?
Yeah, exactly. No, because I think even between us and our community, we benefited a lot from the US, right? Especially as retail public, you don't get access to private placements. You're just really invested in the markets, right? And I think for a lot of people, if you've invested in the US in the last decade, you've benefited from that ride. Right?
No, absolutely.
And most people cannot even tap on that Chinese growth, like what you're talking about, it's very direct, right? Very private placement, early days.
Absolutely.
Right? So the question, I want to re-echo that question, right? Is this thesis going to stand going the next decade?
Yeah, I think if you look at some of the indicators today, I think US still continues to do fairly well. I think at the end of the day, we will just remain guided by the structural trends that we invest into and the opportunities that we see from the markets coming up. And I think we'll continue to invest and we'll continue to reshape based on that. We don't ever form a view that, okay, this is the market and irrespective of what happens.
So how does that work, right? Because in a sense, and as I understand it, you go into an investment with a long-term view, but that long-term view is kind of always shaped by developments. So in practice, how does that work out? Is there a decision point where you go, snatch, my previous thesis was wrong, it's time to go? Or I know it's always a bit of an evolution, it's always a bit slower, but I mean, in a sense, it's a bit contradictory, right? I have a long-term view, but I'm always subject to my views changing. So is that really long-term?
Yeah, so I think first of all, we are a long-term investor, and I think we take a long-term view around all the trends that we invest into and the themes that we invest into. But long-term view does not mean that we just remain invested even when the landscape is changing. And I think that is where we continue to evaluate the trends that we see in the market. And based on those trends, we continue to reshape our portfolio. We reshape by markets. We also reshape by trends and by sectors, right? And you will see us continuously evolve.
So in a sense, it's a bit of a matrix, right? Where we go into a company, we think that because we think, one, there's a good structural trend, two, the market supports it, well, if the market doesn't support it anymore, or if there are better companies that come up within this structural trend, that's time to shift in a sense. If we think that structural trend doesn't persist, maybe it was COVID induced or whatever, then it's time to shift as well. Would that be kind of fair?
Definitely. I think we have to stay true to what we invest into. And I think if there are themes that we have underwritten, either if we believe that those themes have played out and it's time for us to divest, our divestments would be based on two large principles. One, the intrinsic value test. And if we see that, we are there in terms of the thesis playing out, the valuation kind of gives us an indication that this is a time to exit. That's one. The other one is portfolio consideration, as you rightly said, right? If there are other trends that are emerging, we would take some capital off some of the trends that has played out and divert that capital into the new trends that are emerging, the new opportunities that we are seeing. And I think that is the way we kind of try and keep our portfolio true and current as well.
Yeah. I get it, right? So that's the bottom-up investment, methodology, right? Kind of manage that portfolio. But before we go into the divesting, I want to ask a little bit more at the macro geography level, right? In that view, the US, has opportunities. That's from Temasek's point of view. There's still opportunities to continue to invest in the next decade, tied to the trend and the ideas of what Temasek stands for, right? And then you're saying you're increasing a lot of your investments in India and also kind of more cautionary about China. All right. So why this, right? Why are you increasing your investment in India? And why are you kind of more cautionary about China today?
I think if you talk about India, we've been fairly active in India for a while. I think India was our first office that we opened outside of Singapore. So we went in early in 2004. I think the first decade of our investing in India did well, but it was slower. And I think the opportunity picked up in the second decade where we have actually performed fairly well in India. India is now about 7% of our portfolio. We continue to see interesting opportunities emerging out of India. And we are very positive on India. I would say there are a few things that makes India very attractive. I think India has been benefiting quite a fair bit from the structural reforms that you're seeing in India in the recent years. We've seen a lot of political stability in India, and I think that would allow the reforms to happen, that will allow fiscal consolidation to happen. We've also seen a good amount of focus and spending in infrastructure and green transition, and that has allowed manufacturing activity to pick up in India. India also remains a beneficiary of the supply chain dislocation or changes in supply chain that's happening. And they benefit
so neutral,
out of that.
supply chain.
Not de-risking.
Not de-risking. People just shifting around.
So we see that. I think having said that, India is a large consumer market. It has strong demographics, a young population, income levels are growing in India. So we think the domestic consumption will also drive the economy to a large extent. And then if you look at Indian capital markets, India continues to have a very deep talent pool, management talent pool. I mean, not only in India, if you look around the world, you find a lot of CEOs from Indian origin. So it's got a good amount of talent pool there. And I think the last thing I would want to mention is, if you look at India in the recent years, we've seen a lot of domestic innovative businesses starting to emerge in India. So we think that overall, I think India is very well positioned to grow. And I think that's something in the coming years we would want to continue investing into.
Fair.
So in a sense, it's a bit like China 20 years ago, right?
Yeah, that was one.
With a bit more of an openness to the outside world.
Yeah, I think both countries would have their own differences. So I think we got to be able to understand and appreciate the difference and factor the differences in how we invest in. But you're right. I think if you look at trends in India today, they are very similar to what you've seen in most of the growing economies. And we see good opportunities in sectors like consumer, life sciences, healthcare, financial services. We've invested in green transition in India. I'll give you some examples of things that we've invested in India because it gives you a flavor of what we do.
Because it sounds quite
light
on
the
the
private or
capex.
public sector.
Yeah.
On the private or
Either,
public
I think it's
Either
perfect.
side. I mean, we mostly invest into the private side of the business, but we also do active public investing. But private is where it's more interesting to talk about. So we've invested in India's largest private sector bank, HDFC Bank. We've recently, last year, in fact, we announced a very large transaction in a hospital chain called Manipal Health Enterprise. That's one of the largest private healthcare provider in India. And if you would have followed the healthcare sector, It's actually been doing very well in India. We also invested across the green transition in the electric vehicles value chain. So we invested in a company called Mahindra Electric, which is one of the large electric vehicle manufacturer. We also invested in another company, which is a very interesting company called Ola Electric. They actually manufacture two-wheeler electric vehicles.
Two-wheeler?
Right? Two-wheelers.
Okay, so like scooters?
Scooters,
Okay,
right?
okay,
And
okay.
bikes. So I think India, as you know, I think there's a huge amount of need for two-wheelers in that market. So these are some of the kind of investments that we find, and they have been very interesting in terms of the evolution. So we're very excited about India.
Okay. What about China? Give us a bit of color. Like you sound pretty cautionary about it. Although it looks like there's a lot of technology development there also, right? So just kind of want to get your point.
On China, I would say that, again, we entered in 2004. In the first decade, I think we've done very well in China. I think if you look at the last decade, the last 3 years in particular, the capital markets has had an impact on all the investors. I think the markets are down like 46% or something in the last 3 years. And I think that has impacted returns in China for us as well. And I would say going forward, we are not exiting China. I think we still remain invested in China. What we are trying to do right now is to see where are the opportunities for us to invest in China in the future. And what we are trying to do is to not invest too much capital into industries and sectors that are impacted by global trade and the geopolitical conflicts, right? We don't want to be in industries that are impacted by tariffs, for example. What we are investing into, on the contrary, is we are trying to find opportunities that are not going to be impacted by that, but are beneficiaries of having such a large consumer base. They are still consuming. There are still opportunities out there to invest. So we are investing in sectors like consumer that are driven by domestic demand. We are investing into sectors that offer import substitution. So, for example, medical device manufacturing sector. Or we are investing into sectors like green transition. That's a big opportunity in China today. And we are investing across the value chain of electric vehicles.
Tariffs would also be an issue.
Yeah, tariffs.
I think tariffs would be an issue. But if you think about the EVs as an industry, right, they actually don't invest, or they don't have US as that big a market. So if you take the EV manufacturers in China and look at US as a share of their revenue, I mean, it's not that big. They're not that impacted because they're not selling as much in that market. Where they are selling is a lot in Asia and in Europe. And in Europe, they're still very competitive on pricing. Even with the tariffs coming on, they could be very competitive on pricing. So I think they do have some distinct advantage. And domestic market is huge. I mean, just look at the population and the needs of that population.
But the primary idea is because the global markets is not looking at it in a very positive light. So you're a bit more cautionary on...
Yeah, I think we are trying to find the right opportunities that we think can generate value in the future, and not just investing where traditionally we or other investors have invested. So.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC.
Just to probe a bit deeper and to see if there's any lessons for retail investor, right? Is there some sort of benefit from staying the course in a sense, even though it has gone down by that much or underperformed by that much? Just for a bit of a diversification benefit, because you want different exposures. If the other side, falls down, then at the very least there's some exposure there. Does that factor into part of the thinking at all?
We are a very different investor from retail investors. The differences actually drives the decision making for us versus a retail investor, whether it's the investment decision or whether it's the divestment decision. So let's talk about us as an institutional investor. The difference comes from the fact that we actually invest a very different nature of capital. We are a long-term investor, we have permanent capital, and we have the ability to ride through trends across cycles. We also have the flexibility of investing across the capital structure, so we can find investment or best risk-adjusted return across debt and equity and decide where we want to invest into. And as an institutional investor, we also have access to private markets. We can invest at a very early stage. identify winners and invest through their growth cycle as they become regional and global champions and as they get listed, which a retail investor naturally does not have a lot of that access. For a retail investor, a lot of decisions are made on factors that are unique to them. Let's talk about divestment decisions. A retail investors may have considerations like need for personal liquidity because they want to buy a home today. So they go to naturally realize their investments and buy home. It doesn't matter whether you're in the right part of the cycle or not, because that's a big decision. That's where you've been saving for. Or if there is a major medical expense that comes up, or if they need that capital for kids' education. So there are a lot of those factors that drive that decision. But for an institution like us, we would think about intrinsic value test and see, is this the right time to sell? Is the right value to sell? Or we may have portfolio considerations as to how do we want to structure our portfolio. So as I mentioned earlier, take some bets off here and maybe put into areas that we think are emerging and could offer relative better returns than where we are invested into. So I think there are natural differences. So I wouldn't just compare directly, because sometimes when you do that, you kind of drive decision based on wrong factors, right? And I think that's what you don't want to.
You know what Alpin just said? Don't copy us. That's the main thing. That's the main thing. Yeah, we are different. Okay, but I want to understand a little bit more about the divestment side of things, right? Because it's a big part of allocating capital, right? At some point, you want to redeploy, you want to divest from some of these bets and all that jazz, right? So how do you look at divesting from your point of view?
We generally think about it from a few factors. I would say the two main factors is we will look at an intrinsic value test. And if we think this investment is at the right point to be divested, then we'll make that decision. And the other consideration, as I mentioned, was around portfolio consideration, right? So how do we want to construct our portfolio? Where do we see relative opportunities? Where is a better opportunity? Where could we make more or better and sustain long-term returns? And then we'll switch capital around. So I think we got to be flexible. We got to be nimble to be able to reshape our portfolio. Because I think reshaping our portfolio is what allows us to create a resilient portfolio, a future-proof portfolio, right? And what we are aiming towards is to always be able to deliver sustainable return over long term, because we kind of also measure ourselves on long-term returns, right?
Yeah.
So that's our
I need
focus.
you to have sustainable long-term returns.
Yeah, it's true. So maybe how about give us some color? I don't know if you can say this, but like, where are some of your recent divestments? Where are some of the places that you think it's already matured? Let's divest, reallocate, just to give us some color on that.
Or you have hit your IRR and
you're
enough,
done. Let's go somewhere.
It can be a success
else.
story. It's not just because.
Since you're talking about the success story, one of the examples I want to talk about, which would be very useful, cover some of the earlier topics of early stage investing we are talking about, is this investment that we made in Ardian. And it touches upon a lot of aspects beyond the question you asked. So I thought that's a good one to talk about. We invested in Ardian very early in I think 2014 or 15. And we identified at that time that payments is a space that we want to invest. We used to be a very heavy bank investor in the financial services sector, but we have been reshaping that portfolio from banks to diversify into payments, into fintech companies, into insurance, into many other aspects of financial services. And payments was one of the sectors we identified. We invested in this company called Ardian. It was a small startup at that point in time. And we actually supported and invested with them throughout their journey. Today, they actually are a listed company. They are worth 38 billion euros. When we invested, I think they were 1.5 billion. So I think that's the kind of journey we are talking about, where you can identify early winners and you can actually grow with them. You can continue to invest with them as they evolve. And now they are public. We can decide how we want to think about that from an intrinsic value perspective. We will make the decisions on how we think we should be investing in that space going forward. So, but that's a good example of, how we kind of ride through some of the success stories there.
Fair. So that's the successful story, right? I had to ask this, right? Because the converse also holds when you're an early investor. There are some losers in all portfolios, right? And I think the one that is very famous all over the internet is the FTX investment, right? Which, let's just call it, blew up. All right. So I want to understand, like, what is your thought process? Has it then kind of like affect your investment thesis? And you know what I mean? Yeah.
On FTX, unfortunately, we are not in a position to comment because it's going through the litigation. So it's not right for us to comment on that. But maybe let me answer your question more around how we think about early stage investing.
Yeah, maybe the process, right?
Yeah. Early stage investing is an extremely important part of our portfolio construction. Why is it the case? Because on one end, it's highly profitable to invest in them. But on the other end, it also gives us valuable insights and access to emerging technologies. And a lot of that insight and access could be valuable to our portfolio companies as well in terms of cybersecurity, sustainability, a lot of new technologies that can enable and bring in more operational improvements in their business. So I think it's a very important part of the portfolio. The idea there is to identify early winners and grow with them as they get to more regional, more global champions, right? And we will continue to do that. However, having said that, investing in early stage is inherently risky. And we all know there are some that you're going to make it, some you probably won't make it through, right? But what we try and do is to manage our risk systematically. So on one end, we restrict our early stage investments to 6% of our portfolio. So we have risk management in place so that you're not overexposing yourself to something risky. And on the other end, we invest in small ticket sizes. So we get diversification in our portfolio in early stage when the companies are small. If you look at our portfolio today, it's actually quite well split between venture funds who specialize in early stage investing and direct investments that we have made. And Ardian is one of those stories. The other one that I always like to talk about is Zomato. That's a food delivery company in India, similar to GrabFood or Uber Eats that you would have seen in different parts. And we invested in that company when, again, it was an extremely small startup. Today, it is listed and it's worth $21 billion. Right? And we've kind of investing with them through that evolution. So there are inherently benefits. It is an important part of our portfolio, so we'll continue to invest in that. But we do that in a very disciplined manner.
So I mean, thinking about early stage and the place in a portfolio, and just because some retail investors have, especially if an accredited investor has access to certain funds, right? So is the view that there's a bit of a power law distribution in terms of returns, so it has to be very, very broadly diversified. No, and this is the bit that I struggle with, right? If it is better risk-adjusted returns, why not have a bigger allocation? And if it's not better risk-adjusted returns, why do you even have an allocation at all?
From an institution perspective, I think they are inherently riskier. So you got to have a very disciplined approach over that. Diversification definitely helps. So it's good to have a diversified portfolio there. But I think we also have to understand, for somebody like us, these companies evolve. Today, they may be an early stage investment for us, but tomorrow that may be a growth investing. These companies grow, they grow in size. So they kind of come out of that bucket, go into our growth bucket. At times they get into a very mature stage as well. So they kind of evolve as well. So it's not a static in time construction. I think it kind of moves across.
Just to be clear on the 6% risk management there, right? So when the company kind of moves into growth stage and you continue to kind of grow with them and you invest your ticket size with them, do they kind of move out of that 6%?
They're naturally not small anymore. They're naturally not having the same risk profile that an early stage is having. They would mirror very similar to what we would do in our direct investment business, right? Where we invest in both private and public companies according to the trends that we mentioned. And they would be in one of those trends because that's how we choose our investments.
Fair. And I think a big part of investing at this stage is to get that big boost, right? That's what all VCs are trying to do, right? You spread across, then you kind of ride that one company that gets into 1,000x, something like that. But of course, you're much bigger. Can you kind of help us understand like that impact on the overall portfolio? Right? Why are we even here?
That's actually a very good question, because that would allow me to explain to you how our portfolio is constructed today. So if you look at our overall portfolio today, I can split them into three parts. The first part is our global direct investments. These are companies, they are private or public that we invest into, and they are usually aligned to our structural trends. That forms about 51% of our portfolio today, the global direct investments. And they continue to grow and benefit from the macro trends and structural trends in the world. The second part of our portfolio is our Temasek portfolio companies. These are companies like CapitaLand, Mapletree, DPS Bank. They are 40% of our portfolio, but they are the stewards of our capital. If you look at them over a longer period of time, they actually give stable long-term returns, right, from that base. These are mostly Singapore-based
It's the ballast
companies.
to your vessel.
I think you need a strong base to also build a portfolio from, right? And these are the companies that we've been investors for for a long time. And then if you look at the last 9% of our portfolio, it's invested in asset management platforms. And this is an area that we partner with asset managers and then invest across different investment class, right? Across different investment strategies. And we've been growing that part of our business over time as well, with likes of Siviora, Azalea. So that's how our portfolio, and that brings in resilience in that portfolio. And this is what I was trying to allude to across, because you have that piece that brings in a lot of resilience, then you can deliver that return over the long term.
Maybe this is me being English nuts. What does resilience actually mean in this context?
No, I think that's a fair question. Right? That's a fair question.
I think for us, I'll go back to how we think ourselves as an investor. We think ourselves as a long-term investor. So we naturally measure our performance from a long-term perspective. So whether that's a 10-year TSR, whether that's a 20-year TSR, we kind of measure ourselves based on that. If you look at our 10-year, 20-year TSR over a long period of time, you actually would see very stable returns. If you look at our 1-year TSR, you will see volatility in that number. It's naturally driven by the market's volatility, right? So when you say resilience, that's the resilience that we are talking about. And when we look at our portfolio companies, we want to make sure they are resilient as well. They have strong balance sheets that can withstand shocks, that can withstand cycles. We want to make sure that they are resilient from a sustainability perspective. We also look at it from the perspective that they are well positioned in their core business to be able to grow and to be continue to evolve and transform. And that's the resilience. Of course, that's all driven by the board and the management team, and they drive all of that. We don't direct them, but that's the resilience that we are talking about, that we want in our portfolio companies. And this is not just the Temasek portfolio companies in Singapore. Even our global direct investment companies that we invest into, we're looking for that kind of resilience.
So in a sense, it's resilience at two levels, right? At your investment level, it's really about low volatility, being able to deliver stable, consistent returns year on year. At the company level, it's about, well, do they have a sustainable business model? Maybe some sort of ESG, factor comes into it. I don't know.
It's an important part.
It is an important part, despite my joking. Hey, it's important to me.
Okay, important.
But there's that resilience at the company level in terms of its financial performance as well.
Absolutely.
That's why Mandai have to have a hotel now. It's monetizing.
ESG is multiple facets, right?
Okay.
I mean, ESG, sustainability is important today. I think it's core to everything we do and everything that the street does as well.
Fair.
So I think ESG and sustainability, if you see in the recent years, has been a very important element.
Although we joke about it, huh?
We want to hear your view. Is it important from a humanity point of view, or important in terms of investment returns?
Yes.
If you think about us, I mean, sustainability is at the core of everything we do, right? It is not only important for us, it's actually an enabler for us to be able to deliver that resilience and that sustainable long-term return, right? Let me explain our sustainability strategy into 3 parts, right? One is investing into sustainable living trend. Sustainable living trend now forms 12% of our portfolio. And what we do is that we invest into many different themes. Let me touch upon maybe 3 of them, right? Clean energy. It's a very important element. We recently invested in a company called Neovan in France, right? They are into clean energy. Second element, clean transport. Investing into EVs and the value chain of his Mahindra Electric that we spoke about is a great example. Ola Electric is a great example of that. Clean materials. So we invested in this company called H2 Green Steel, and that manufactures green steel. Very important part of the world today. So I think we kind of invest and we want to increase our exposure to that part of the portfolio. The second part is decarbonizing our portfolio companies. Right? We engage them. We share our network with them to be able to help them through their decarbonization journey. I think a good example of that would be the Sustainable Aviation Fuel Partnership that we have with Singapore Airlines. Very important. I mean, airline is going to be an important factor for us as well to be able to bring down our carbon footprint and meet our goals, right? That's the second example, I would say. And third, we actually enable carbon markets, which is going to be an important feature in sustainability journey. And we do that through our platforms like Gen Zero and CIX. But to your point, is it profitable? Is it going to make money? I think real estate is a good case in point to talk about. Sustainability in real estate is actually very, very important because real estate forms 40% of the net emissions in the world. And this is a combination of both embedded carbon and operational carbon. And we got to tackle at both the levels. We got to tackle at new builds level, wherein you use new construction technologies, you use more sustainable materials to develop, and at the operational level where you use emerging technologies to be able to bring down your energy consumption, right, through your HVAC systems, etc., right? And if you look at real estate industry itself, all the stakeholders in real estate, whether they are regulators, owners, tenants, lenders, they all have embraced sustainability fairly well. I'll give you two examples. One, in the UK, if your asset green E and better rated, only then you can lease your assets. So if you talk about profitability, there's no even existence without that, right?
Yeah, that feels like Europe in general, right? You need to be green, then you can exist.
Absolutely. You take an example of US, and there's enough data points you can go and look there. In New York, if you look at the rents for green LEED buildings versus rents for non-green LEED buildings, the difference is substantial. And this is what will drive a part of your returns and value creation over the longer term going forward. So it's just becoming a part of the industry. Real estate is a great example. I always bring people back to that example because it's very tangible.
Yeah, okay, fair. But in that breakdown, that 3-part breakdown that you were talking about, I mean, I totally understand the whole carbon market thing, right? Like essentially it's a new market, you're kind of monetizing that transactional process, right? So that is that. And then there's the part where it's a potential loss of profit. You know, not so much like, if we go green, we're going to increase our rent because everybody is expected to go green, right? Something along those lines. But to be clear, to round that discussion off, the fundamentals of a business still matters, right? So when you're investing in a so-called a green provider, you know, you're still expecting them to grow like no other business, right? So green is just their offering, but the core of the business still stands, right?
Absolutely. I think investing into a business for us is not just one factor. It's a combination of many factors. And I would say over the years, sustainability has gotten integrated into our investment approach.
It's not just one of your 4 key trends, right? It's now also become part of the process.
Yeah, and above the trends, we also look at the commercial case for a company.
Like electrifying, you know, those things are important. Okay, fair. Okay, so to round this all right, thanks for sharing, right? There's a lot of, you know, juice over there, right? But I do want to ask a little bit more about the Temasek portfolio company, right? Because those companies go beyond investment thesis, right? They create jobs for the people. They're pretty much anchored in the social and economic fabric here in Singapore, right? It's not like we're just investing in a big trend that's gonna go 20 years, 30 years down, I'm gonna make Temasek money and it's just gonna benefit everybody in that sense.
It's not Adian.
It's not. It's actually gonna bring the country to the next level. It's important, right? So I just want you to kind of close off the discussion to talk a little bit about like what are these companies doing alongside you to bring the nation forward. You know why I'm going with this? Yeah.
No, absolutely. Taking it one level up, talking about Temasek itself, not only the portfolio companies. If you think about our journey in Singapore, and if you sit back and reflect upon it, we are actually very deeply rooted in Singapore's history. And at the 50-year juncture today, I think if you think about our journey and our transformation from being Singapore holding company to an international company, we actually have been driven very, very strongly by our sense of purpose to do well, to do right, and to do good. And our purpose is so that every generation prospers. And I think that's the philosophy that drives a lot of activity that we do. And I think the same goes for our portfolio companies. They are socially responsible as well. And if you look at us over the years, I think we've been fairly focused on do good. And I think we have been strongly connected with the community here. In fact, we do set aside a part of our returns over our cost of capital to be able to enhance some of the community initiatives that we have, right? And Temasek Trust has been one of the beneficiaries and who has been actively involved in some of the local initiatives. So it's a very important part of our business. It's actually, I would end up saying that that's embedded in our DNA. I've been here for 2 decades out of the 5 decades of existence. And I can tell you as a person, it's now embedded in my DNA. So that's the strong sense of purpose that we have within the firm.
That was quite nice. That's a good ending.